Are you thinking of selling your home in Spokane? Capital gains tax can be a huge factor when considering selling either your personal or investment property, depending on the price point. Let's take a look at everything you need to know. Welcome back to Living in Spokane, Washington. If you're new here, my name's Hunter McKay, and I'm your local real estate broker. If you're thinking of buying or selling in Spokane, please don't hesitate to contact me. My contact information is in the description below, and I would love to meet with you and make sure that everything goes smoothly with your process. Now, let's get into today's video. So what are capital gains tax? Let's say that you bought a house for $100,000, and then later when you go to sell it, it's worth $200,000. Now, I know this is 1894, or it's like rural Topeka, Kansas, but let's pretend for the sake of easy math. At $200,000, you might have 10% in expenses. That's commissions, that's taxes to the state of Washington, that's excise tax, that's title, escrow, all of your recording fees. All of that is going to be 10%. So let's call that $20,000. That means that your net profit is 80 grand, because you're at 180 minus your principal mortgage at 100,000. In this hypothetical, we're not going to account for payments made against principal. We're just going to keep the math and make it easy. So that $80,000, that's your profit. That winds up being your capital gain if we're talking about your investment property. There are two types of capital gains. There's short-term and long-term capital gains. Short-term is anything that's made inside of a 1-year period, that's 12 months or less, and then long-term capital gains is anything over 12 months. The big difference between the two types of long-term and short-term classifications are short-term is taxed at your current tax rate. So if your current tax rate is 24%, your short-term capital gains tax rate is 24%. Your long-term capital gains rate is less. Depending on how much you make and what else has happened in your circumstances that year, that number can be wildly different. Everyone's going to say, no, isn't long-term 15%? Sure, sometimes. Sometimes it's 15%. But there are lots of different reasons why your long-term capital gains tax could be higher. And so you always want to work with a good real estate broker and a good tax accountant in advance. That way you know how to protect yourself against capital gains taxes. Next, let's talk about different exemptions that apply to capital gains tax and different ways that we can reduce the expenditure of our capital gains tax in any circumstance. Now, be aware, a really good tax accountant or a tax attorney is going to be infinitely more wise than myself at providing these options. It's what they're trained to do. However, they're also a lot more expensive. And so depending on how big the game is that you're playing, you have to decide how big a swing you want to take at this and whether or not it's worth it to go hire a really big dog professional or just work in-house using the rules that you can find online. But this is a really big decision, and so I recommend at least working with a really talented broker and figuring it out from there and deciding if it's worth seeking additional counsel. One of the first things to know about exemptions that's really simple to memorize is if you're a single filer, you get a $250,000 exemption on capital gains for your primary residence. That means if you buy that home for $100,000 and you sell it for $200,000 and you have an $80,000 net profit, you don't have to pay tax if that was your primary residence. You do have to pay excise tax to the state of Washington, but that is a much, much lower percentage. It's something like 1.11% or something. And so when I think about protecting $80,000, really up to $250,000 of capital gains on your primary residence, that's huge. And if you're married on a joint filer, you get $500,000. So for most of you, that's going to cover a lot of your equity unless you're in a really high-priced area that started off in a really low-priced time frame when you bought it. I bet a few of you are thinking right now, but Hunter, I don't live in my property anymore. I turned it into a rental 15 years ago and I've been collecting income on it. It's tripled in value and I want to sell it. I don't want to give all of my money to the tax man. What am I going to do? I totally hear you. We have a couple of options when we go through this. If you want to cash out, so to speak, you want to sell your property and you do want to get all of the money back out and you don't want to reinvest, you're going to have to pay some taxes. That's just the way that it works. You bought a property, now it's giving you capital back. The government wants its due. However, if you do a 1031 exchange and you reinvest all of the money into another investment, then you don't have to pay the taxes. And this is called a 1031 exchange. We can do another video that goes in depth about 1031 exchange. However, the big thing to understand is you have to buy a property that is more expensive than the one that you sold, and you have to carry greater debt than the property that you let go of. And so let's say you sell a property for $500,000 that had a loan of $250,000. You are going to have to borrow more than $250,000 and pay more than $500,000 for the next one to qualify. Otherwise, you'll have to pay some taxes. One of the other major ways to reduce your capital gains expenditure is making sure to keep track of all of your improvements, because you can use your improvements as a deduction against your capital gains to reduce how much you have to pay. It's very important to know to work with an actual tax accountant when figuring out how much am I going to be expected to pay for capital gains, because no one is going to keep track of this for you except the IRS, and they're only going to keep track of it if you get it wrong and they want more money from you. So I am not qualified to do the calculations. I always hand that over to my partner, Ryan, who is a fabulous tax accountant, and he is available in certain circumstances to facilitate these questions when he is filing your tax returns. And so if anyone is interested in a new tax accountant, I will put his contact information in the description. One of the biggest things to keep in mind, especially for the local Spokane market, is that if you're a seller in 2024 and you've owned your property for a long time, we've had a massive increase in property values. And depending on what your basis is on your property for when you bought it, you could have a pretty big capital gains tax bill. So it's really necessary to use Ryan's number in the comments below and call him and figure out what you can do in order to mitigate your expenditure on capital gains tax. And then call me when you're ready to sell your house. That way we can make sure that you get the highest dollar possible for it. If you have any comments or questions that we didn't cover during the video, please leave them below and we'll make sure to get you a personal response. And please don't forget to like, comment, and subscribe, and check in for next time.